Jason, what was the catalyst for the big turnaround yesterday, and how do the charts look to you now?
Yeah, so I mean, on a medium-term basis, we'll take a step back and think about how we thought about this year for the S&P. And of course, with the Fed lifting off from a zero policy rate, that would be one of the dominant factors. When you look back at the 4 prior economic cycles, when the Fed moved from very accommodative for the first time in those cycles, the S&P did a very similar thing, a 6-month trading range, 10 to 15% in amplitude. But the important thing is that marked a consolidation, a mid-cycle consolidation, not the end of a bull market. So that's kind of the playbook we've been going on. Yeah, 4 times isn't a strong statistical study by any means, but the consistency in the price action surrounding those events, led us to think that was the right way to think about it. And when you equate that to the S&P peak from January, 10 to 15% gives you a 4,100, 4,300 support zone. So far, sentiment as we got down into that area got very bearish. Yes, we're not just talking about Fed tightening anymore. Now there's geopolitical concerns that raise the risks around our view.
Right.
But for now, the price action the last 48 hours seems to validate what we're thinking about, getting buy signals as the market bounces off those lows.
Some of the traders who were encouraged by those buy signals are still telling people it's only a technical trading rally and that they're still bearish on the markets in kind of the medium term. Would you differ with that?
Yeah, I would. I mean, those that looked at the S&P as this broad head and shoulders top pattern, when you think about what that pattern would suggest, you're talking about a 20 to 25% drop from the January peak. Normally, those types of drops are associated with economic contraction. It's not always, but most of the time. You look at the 2s10s curve, even with the flattening we've seen and the reshaping of the money market curve around the hawkish Fed pivot, the 2s10s curve is still not inverted yet. That usually happens well ahead of a market top like that. So we're not in that camp. Yes, it could be a technical bounce. We think we're range bound for a while here. We don't necessarily think we're off to the races again. But we are more constructive than the idea that this is a bear market rally.
I was going to ask you whether you think that we're really stuck in sort of a trading range. You answered that. What is that range?
So for the S&P, we already talked about the downside, 4,100, 4,300, we think defines the lower end of the range. I would say for the next month or so, maybe 4,600 still a sticking point. The important part is, though, we like value over growth, and we think an index like the S&P 500 value could actually go on to make new cycle highs as the broader S&P trades in a range and as growth and indices like the NASDAQ probably struggle for a little bit here.